Here's something most people in Australian personal finance don't really talk about properly, mate. Super is honestly one of the best investment systems. Australians have access to low-tax, long-term compounding, set up to grow quietly in the background for decades. But there's one catch nobody thinks about until later: you can't actually touch it until around 60. And these days, more and more Aussies don't want to work full-time all the way until then. Some want to slow down at 45, some want part-time work at 50, and some just want freedom earlier. That creates what's called the retirement gap, the years between when you want financial freedom and when your super actually unlocks. Now the good news is there's a strategy built almost entirely around ASX investments that can actually bridge that gap. Basically, it's designed to create income outside of super so your investments cover your lifestyle while your super keeps compounding untouched in the background. That's what people call the bridge strategy, and honestly, mate, it's way simpler than most finance people make it sound. By the end of this video, you'll understand the two main building blocks of a proper ASX passive income portfolio, why Australia has a tax advantage investors in most countries would kill for, and the three beginner mistakes that quietly wreck returns without people even realizing it. And more importantly, you'll see how regular people can actually build a portfolio that starts generating real income over time, even if you're starting small. 3 mistakes, 2 building blocks, 1 simple system. Let's get into it, but first, picture this for a second, mate. Imagine waking up at 45 knowing your investments already cover your living costs. Your super is still compounding in the background untouched, but your portfolio outside super is already paying the bills. That's the real goal here, not flexing screenshots online, not chasing meme stocks because some bloke on TikTok said it'll 10x overnight. Just quietly building a system that slowly buys your freedom back 1 year at a time. And the foundation of that system starts here. The first level is the ETF core. If you're new to investing, an ETF is basically just a basket of shares bundled together into one investment. So instead of trying to pick one winning company, you buy a little slice of hundreds of companies all at once. For example, when you buy VAS, Vanguard's Australian Shares ETF, you're automatically buying exposure to companies like BHP, Commonwealth Bank, CSL, Wesfarmers, Macquarie all in one hit, and honestly this matters for two big reasons. First is diversification. If one company completely blows up tomorrow, your whole portfolio doesn't collapse because your money spread across hundreds of businesses. Second is cost. VAS charges a management fee of just 0.07% a year. So on a $100,000 portfolio, that's only about $70 annually. Compare that to some actively managed funds charging over 1% a year, and suddenly you're talking about paying over $1,000 in fees instead. Over decades, that difference compounds massively. The other ETF a lot of Aussies use is A200 from BetaShares. It tracks the ASX 200 instead of the ASX 300 and has an even lower fee at 0.04%. But honestly, mate, over long periods they perform pretty similarly because the biggest companies drive most of the market anyway. For beginners, either one is completely fine. The actual ETF matters less than the behavior behind it. And that's where dollar cost averaging comes in. Now don't let the fancy name scare you. Dollar cost averaging is literally just investing the same amount regularly no matter what the market's doing. $500 every month into an ETF whether the market's booming, crashing, or going sideways. That's it. The reason it works is because it removes emotion from investing. When markets fall, your money buys more units. When markets rise, the units you already own become more valuable. You stop trying to predict the market and instead let time do the heavy lifting. And this is where people underestimate compounding massively. $500 a month invested into a broad ASX ETF earning around 8% annually grows to roughly $91,000 over 10 years. You only contributed about $60,000 yourself. The market added the other 30 grand. Stretch that to 20 years and suddenly you're looking at close to $300,000. Same boring monthly investment. Same simple ETF. Just time and compounding doing what they do best. Now here's rookie mistake number 1: brokerage bleed. This quietly kills beginners. If you're investing small amounts every month but paying $20 in brokerage fees every trade, you're basically donating your returns before investing even starts. If you invest $500 and lose $20 immediately to fees, that's 4% gone instantly. That's basically an entire year of dividends wiped out before compounding even begins. These days there's honestly no reason for that. Platforms like Stake, Perler, and ComSec Pocket offer super cheap investing options for smaller amounts, so keep your fees low and let more money stay invested. Now once your ETF core is set up, the second building block is LICs, listed investment companies. And this is where things get really interesting for passive income specifically. See, ETFs simply pass through dividends from the companies they hold. If company dividends fall during a bad year, your ETF income falls too. But LICs work differently because technically they're companies themselves. That means in strong years they can keep some profits in reserve instead of paying everything out immediately. Then during weaker years, they can use those reserves to maintain more stable dividends for shareholders. That's called dividend smoothing. Good example is AFIC Australian Foundation Investment Company. Mate, they've been paying dividends for over 80 years. Through the GFC, through COVID, through all kinds of market chaos. Same story with Argo Investments. That consistency matters massively if you're trying to build predictable income before your super becomes accessible. The easiest way to picture it is like this. ETF dividends move up and down with the market a lot more. LIC dividends look smoother and steadier over time. And if your investments are eventually paying your bills, stable income matters more than flashy return screenshots online, which brings us to rookie mistake number 2, yield chasing. This one traps heaps of beginners. People see some random company paying a 12% dividend yield and think, mate, that's amazing. But usually the opposite is true. High yields are often warning signs. Dividend yield is calculated using the share price. So if a company's share price crashes because the business is struggling, the yield suddenly looks massive. That juicy 14% yield might actually be the market screaming that something's wrong and a dividend cut is coming soon. Chasing massive yields without understanding the business is like walking toward the fire instead of away from it. Long-term investing is usually much more boring than people expect. A reliable 4–6% yield from strong diversified investments beats unstable double-digit yields almost every time over the long run. Now this next part is honestly one of the biggest advantages Australians have when investing: franking credits. And investors in most countries don't really get anything comparable. Basically, when Australian companies pay tax on profits and then pay dividends to shareholders, the tax already paid can come attached as a franking credit. So instead of profits being taxed twice, shareholders receive credit for the company tax already paid. Here's the simple version. If a company earns $1, pays 30 cents in company tax, and gives you the remaining 70 cents as a dividend, you also receive the franking credit attached to that tax already paid. So your real return is higher than the cash dividend alone makes it look. And mate, this changes the maths properly. A fully franked 4% dividend yield can effectively become around 5.7% depending on your tax rate. For retirees or people in those bridge years before super access, excess franking credits can even come back as cash refunds from the ATO. That's huge. This is why the ASX is actually one of the best passive income markets in the world. US ETFs might only yield around 1.15%, while ASX portfolios with franking credits can produce significantly higher effective income. For the bridge strategy specifically, that difference matters massively because your portfolio income is literally helping fund freedom before super unlocks. So now all the pieces connect together. The ETF core gives growth and diversification. The LICs give smoother, more reliable dividend income. Franking credits boost the effective yield. And together they create a portfolio designed to steadily grow while generating increasing income over time. The easiest structure for most people is what's called a core and satellite portfolio. Around 80% goes into broad market ETFs like VAS or A200, that's your growth engine. Then roughly 20% goes into LICs like AFIC or Argo to help stabilize income and add consistency across market cycles. Simple, nothing fancy, but incredibly effective over long periods, and the cool part is this scales naturally. $150,000 portfolio might generate roughly 5 to 6 grand annually after franking credits. A $600,000 portfolio could generate somewhere around 20 to 24,000 a year. Meanwhile, the portfolio itself keeps compounding and growing in the background. Now rookie mistake number 3, and honestly the hardest one psychologically, is panic selling during downturns. Every crash feels different while it's happening. Every time people think, this time is different. But the ASX has fallen more than 20% multiple times over the past few decades and recovered every single time. The people who panic sell lock in losses permanently. The people who stay consistent or even keep buying during crashes are usually the ones who benefit the most during recoveries. That's really the whole mindset shift here, mate. The portfolio is a machine. Machines don't care about headlines, fear, or market panic. They work through consistency, and honestly the bridge strategy itself isn't complicated. ETF core for growth, LIC satellite for stable income. Franking credits boosting the effective yield, then just consistency over time. That's the machine. If you want the spreadsheet used to track dividend income, franking credits, and portfolio progression across the passive income levels, it's linked below. And chuck a comment down there telling me where you're at right now. Are you building for growth, building for income, or still trying to figure out which one should come first? And if this video helped, share it with someone who needs to hear it, mate. Subscribe to the channel, turn on notifications, and I'll see you in the next one.